All right, so today we are going to deep dive headfirst into high-yield dividend ETFs.
Ooh, sounds exciting.
Yeah, these things are all about potentially, grabbing some of that passive income
Oi.
while still letting your portfolio have some space to grow.
Yeah, who doesn't love that?
Exactly.
Especially with, the markets being all over the place these days.
Yeah, exactly. And a recent Motley Fool article really got us thinking about this.
Hmm.
They highlighted two ETFs in particular.
Okay.
The Vanguard High Dividend Yield ETF,
Okay.
ticker symbol VYM,
Got it.
and the Vanguard Real Estate ETF, ticker symbol VNQ.
Okay.
So I was hoping maybe you could help us kind of break these down a little bit.
Yeah, absolutely. There's a lot to kind of unpack there,
Yeah, for sure.
especially with how they fit into the current, economic landscape.
Yeah, well, first off, interest rates are super high right now. You can
Mhm.
get like a 4% yield just from a high yield savings account.
Yeah.
But that doesn't exactly give you huge growth potential.
No, it's that classic dilemma, right?
Yeah.
Like guaranteed, but like limited return versus like higher potential gains. But then obviously there's more risk there.
Yeah, for sure. And so that's where these dividend-paying stocks packaged up all nice and neat in these ETFs get really interesting. And the Motley Fool piece is kind of making a case that they offer the best of both worlds.
Yeah, and I think for good reason.
Okay.
Dividend-paying stocks, especially when they're diversified through an ETF, can offer a really compelling blend of income and growth potential.
For sure. So let's start with VYM.
Okay.
One of the things that really stood out to me is just the big name companies it holds, like Broadcom, JP Morgan Chase, ExxonMobil, Home Depot. These are household names we're talking about here.
Yeah, for sure. And I think that's one of the strengths of VYM is it's focusing on well-established companies that have a history of stable earnings and dividend payouts.
Okay, but are those dividends reliable?
Yeah.
It's not like companies are required to keep paying those outright.
That's a great question, and it really highlights, I think, why the quality of the companies in the ETF matters. Okay.
So the companies that are in VYM are not just random dividend payers. These are industry leaders with solid cash flows. So this means they're more likely to maintain and even grow those dividend payments over time,
Okay.
even when the economy, throws a curveball or two.
Gotcha. That makes sense. And speaking of growth, the article mentions VYM has had an average annualized total return of 10.2% over the past decade.
Yeah, it's impressive.
Yeah. Is that all from the dividends, or is there more to it?
It's a combination.
Okay.
So the total return includes both the dividends that you receive and any increase in the ETF's share price.
Okay.
So you benefit from both the income stream and the potential for that capital appreciation as well.
Okay. So you're getting paid and the price is going up.
Exactly.
Gotcha. That's pretty impressive.
Yeah.
What about fees, though?
Yeah.
Aren't those pretty important?
You're absolutely right. Fees are an essential factor to consider with any investment.
Mm-hmm.
Fortunately, VYM boasts a very low expense ratio
Okay.
of 0.06%. So that means for every $1,000 you invest, you're only paying 6 cents in fees annually.
Okay. That's not bad at all. All right. Let's turn our attention now to VNQ,
Right.
the Vanguard Real Estate ETF.
Mm-hmm.
This one seems a little different from VYM because it focuses specifically on REITs.
Yeah.
And those are companies that own and operate like properties, shopping malls, apartment buildings, things like that.
Exactly. So VNQ provides that exposure to the real estate sector. But I think what's essential to understand here is how interest rates affect REITs.
Okay.
Because you see, when interest rates rise, as they have, recently, borrowing costs for REITs increase, which can then impact their profitability and their dividend payouts.
Okay.
So that's why 2022 and 2023 weren't the most favorable years for REITs.
So does that mean VNQ is kind of a risky bet right now?
Not necessarily.
Okay.
While rising interest rates have put some downward pressure on REITs, the Federal Reserve has recently started cutting rates.
Okay.
And expectations are for this trend to kind of continue. So this could be a potential turning point for VNQ.
Interesting. So are investors supposed to hold their breath and just wait for VNQ to make a comeback, or?
It's certainly possible.
Okay.
Historically, REITs tend to perform well when interest rates are declining.
Okay.
So as borrowing costs decrease, REITs can potentially acquire more properties, increase rents, and ultimately boost their earnings and dividends.
Okay. That makes sense.
Yeah.
So while VNQ maybe has had a rough couple of years, there's reason to believe it could be poised for a rebound.
Yeah, that's the theory.
Okay.
And remember, with a current dividend yield of 3.7%, even if the share price stays flat, you're still collecting, a decent stream of passive income.
Okay, that's good to know. The article mentioned that VNQ has had total returns similar to or even slightly better than the S&P 500 with less volatility.
Yeah.
Can you unpack that a little bit for us?
Sure. So the S&P 500 is often used as a benchmark for the overall stock market.
Yeah.
So VNQ's historical performance suggests that it can potentially deliver those competitive returns compared to the broader market, but with less dramatic ups and downs.
Yeah.
So it's kind of like a smoother ride, which might be particularly appealing to investors looking to, minimize risk and sleep soundly at night.
Yeah, makes a lot of sense.
Yeah.
Well, we've only just kind of scratched the surface here.
Yeah.
There's a lot more to uncover about these two ETFs and how they might fit into your portfolio. So stick with us, and we'll be back in a moment to continue our deep dive.
All right. See you soon.
Okay, so we're back, and we're ready to keep on going with these high-yield dividend ETFs.
Right.
Before we went to break, we were talking about how VNQ could be setting itself up for a comeback as interest rates start to fall.
Mm-hmm.
I'm kind of curious, what types of properties does VNQ actually hold through these REITs?
Yeah.
Does that affect how it might perform?
That's a great question. And VNQ is pretty diverse.
No.
I mean, we're talking everything from apartment buildings to office space to shopping centers and even things like self-storage facilities.
Wow. Okay.
So yeah, understanding that mix can definitely give you some insight into its potential risks and rewards.
So if somebody was really bullish on, like, say, the growth of e-commerce,
Yeah.
would VNQ be a good way to kind of like play that?
It might be, but you'd have to look at the individual REITs that are held within VNQ to see how much they rely on things like warehouse space and logistics centers.
I gotcha.
VNQ is broadly diversified across the real estate sector. So it's not like laser focused on any one trend.
Okay, that makes sense. Now, we've talked a lot about VNQ and interest rates. Let's go back to VYM for a second.
Okay.
The article highlights VYM's really impressive returns, even beating the S&P 500 at times. What drove that, and can investors count on that going forward?
It's important to remember that past performance isn't a guarantee of future returns.
Yeah, right, of course.
So VYM's strong performance over the past decade was really influenced by, I think, a few different factors. We had a favorable economic environment. We saw steady dividend growth from those underlying companies.
Okay.
And there was just a general increase in investor demand for dividend-paying stocks.
So are you saying that those factors might not be in play anymore?
Not necessarily, but we have to be realistic.
Okay.
We're in a different economic climate now than we were a few years ago.
For sure.
And some of those tailwinds that boosted VYM may not be as strong moving forward.
So what does that mean for somebody who's considering investing in VYM right now?
It means that doing your due diligence is absolutely critical.
Okay.
Don't just look at the past performance.
Yeah.
Dig into the current fundamentals of the companies that are in VYM.
Okay.
Are their earnings still growing?
Mm-hmm.
Are they managing their debt well?
Okay.
Are their dividends sustainable?
Okay.
Those are all really important questions to ask yourself.
That's really helpful advice. I think it's easy to just get caught up in those big returns. But like you said, past performance isn't a crystal ball. Now we've spent a lot of time talking about VYM and VNQ. I know there are a ton of other dividend ETFs out there.
Yeah.
How should our listeners kind of approach choosing the right one for them?
It really starts with understanding your own personal financial goals,
Okay.
your risk tolerance, and your investment timeline.
Right.
So what are you hoping to achieve with this investment?
Okay.
Are you looking for passive income growth potential or a blend of the two? How much risk are you comfortable taking on?
Okay.
And how long do you plan to hold the investment?
Okay.
Those answers are really going to help guide you to the right ETF.
So for somebody who really prioritizes stability and like wants to sleep well at night, knowing that they're receiving a steady stream of income, VYM with its blue chip companies might be a good fit.
Yeah, it could be. But it's also important to remember that even the most well-established companies can face challenges.
Right, for sure.
So diversification is still really important even within a dividend ETF.
Okay, and somebody with like a longer time horizon, maybe a little bit more risk appetite, VMQ with its connection to real estate and that possible rebound as interest rates fall might be more appealing.
It's possible, but again, diversification is key. Don't put all your eggs in one basket, so to speak.
Yeah.
Consider including other ETFs or investments that provide exposure to different sectors and asset classes. This can really help smooth out your returns over time and kind of reduce the impact of any one investment performing poorly.
Okay, so we've talked about aligning investments with your goals,
Yeah.
understanding risk tolerance, and, of course, diversification.
Absolutely.
What else should our listeners be thinking about as they're kind of navigating this world of dividend ETFs?
Fees.
Yeah.
Don't forget about fees.
Mm-hmm.
We talked about how VYM has a low expense ratio.
Right.
But that's something you want to look for with any ETF you're considering.
Okay.
You know, every penny that you're paying in fees is a penny that's not working for you.
Exactly. And those fees can really eat into your returns over time.
Yeah.
Speaking of returns, how do taxes factor into all of this? Are dividend payments treated the same as like regular income?
That's a really important question, and the answer really depends.
Okay.
It depends on the type of account that you're holding the ETF in and the specific tax laws, wherever you live.
Gotcha.
Generally speaking, though, dividends are taxed as ordinary income.
Okay.
However, qualified dividends, which are dividends paid by U.S. corporations that meet certain criteria, may be taxed at a lower rate.
Okay. So it's not like a one-size-fits-all answer.
Right, exactly.
Yeah.
It's always a good idea to consult with a tax professional to understand, those specific implications.
Yeah, that's solid advice. Any other words of wisdom for our listeners as they kind of go down this road of dividend ETFs?
Yeah, I would just say, remember, investing is a marathon, not a sprint.
Okay.
Stay informed, do your research, and don't be afraid to seek guidance, from a financial advisor if you need it.
Yeah, for sure. Great advice. All right, let's shift gears for a moment and let's talk about market volatility for a sec.
Mm-hmm.
We've seen some crazy swings lately, and I know that can make even the most seasoned investors a little uneasy.
Yeah.
How do these dividend ETFs, especially VYM and VNQ, hold up in a crazy market like this?
That's a great question, and something you definitely want to think about if you're considering ETFs.
Yeah.
While no investment is totally immune to market fluctuations,
Right.
dividend ETFs like VYM and VNQ can offer a little bit of stability.
Okay.
Because remember, they're built on these companies that have consistent earnings, and they're paying those dividends.
Mm-hmm.
So it can provide a little bit of a cushion when the market takes a dip.
So even if the share price drops,
Right.
you're still getting those dividend payments to kind of soften the blow a little.
Exactly. Those dividends can give you some peace of mind.
Yeah.
And help you kind of ride out the storm without making, rash decisions.
Gotcha. That makes sense.
Yeah.
But what if one of those like rock solid companies in VYM just totally tanks or, they cut their dividend?
Right.
Does that put the whole ETF at risk?
Well, that's a valid concern, but remember, that's why we like diversification so much.
Mm-hmm.
One of the key benefits of ETFs,
Right.
even if one company in VYM really struggles,
Yeah.
the impact on the overall ETF is going to be pretty limited
Okay.
because it holds a whole basket of stocks.
So don't put all your eggs in one basket, right?
Exactly. Spread that risk around.
Okay.
And VYM focuses on those well-established, financially sound companies, so that reduces the risk even more.
That's good to know. I want to go back to something you said earlier about aligning your investments with your goals.
Right.
Can you give us some like real world examples of how VYM and VNQ might fit into different strategies?
Sure. So let's say you're getting close to retirement
Okay.
and you're looking for some reliable income to add to your savings.
Okay.
VYM, with those consistent dividend payments, could be a good option for you. You're building a portfolio that generates a nice steady stream of cash flow.
It's like building your own pension in a way.
Yeah, kinda.
Now, what about somebody who's a bit younger,
Yeah.
maybe has more time to let those investments grow, and they're okay with a little more risk?
Yeah.
Would VNQ be a better fit there?
It's possible
Okay.
because, you have that connection to real estate,
Right.
and there's that potential for it to rebound as interest rates come down.
Okay.
So you're betting on that long-term growth of real estate,
Yeah.
but you're still collecting those dividends.
Oh, okay. I see how those could fit into different situations.
Yeah.
This has been super helpful.
Good.
Any final thoughts for our listeners before we wrap up?
I think just remember that knowledge is power when it comes to investing.
Mm-hmm.
Ask questions. Do your research.
Mm-hmm.
And don't be afraid to reach out to a financial advisor.
Yeah.
Most importantly, stay curious and keep learning.
Great advice. Well, that brings us to the end of our deep dive into the world of high-yield dividend ETFs. Hopefully you found this helpful and maybe even spark some ideas for your own investing journey.
Yeah.
Until next time, happy investing.